New York City for our audience worldwide. Bloomberg Real Yield starts right now. We begin with the big issue, a whole lot of cash looking for a home.
I really think you do have an asset shortage.
There's a collateral shortage.
There is a lot of liquidity sloshing around.
There's too much cash.
And it's just looking for a home.
You cannot find income in fixed income.
It's hard to believe when you're talking about the types of deficits that we have.
It has big asset implication.
We have certain visibility on how much further liquidity we're going to get.
When you add it all up,
it's a big number.
$1 trillion of additional reserves to hit the banking system in the next 2 months.
Combine very easy monetary policy with the need for fiscal policy.
You're somewhere between 20 to 25% of GDP.
That's massive.
It means a bear market in U.S. Treasuries.
There's going to be additional downward pressure at the front end of the curve,
putting the Fed in a really hard position.
When there's a lot of cash in the banking system.
Powell telling us that they're sitting on the short end probably till 2023.
You push investors a bit further out in their preferred habitat.
It's quite powerful.
Joining us now, BlackRock's Jeffrey Rosenberg. Jeff, always great to catch up with you, sir. A couple of different things going on here. I want to start with the front end of the curve, and we'll talk about the flexibility in the back end in just a moment. Can you walk me through the dynamic that's taking place at the very front end? We saw the two-year yield drop below 0.1% earlier this week. Do we truly have what some people are referring to as an asset shortage?
Well, the asset shortage is just the flip side of the other comments that you heard in the opening, which is just a ton of liquidity. So you can look at it on either side, but the story remains the same, that whether we don't have enough assets or whether we have just so much liquidity, it's the difference between the two that's driving so many different asset classes and so many different asset prices to valuations and to valuations that are increasing.
Some real distortions here, Jeff, and I think the commercial paper market in Europe's a decent example of this. The Wall Street Journal wrote about it in the past week. They talked about the negative yields there, but the real story is the demand-supply dynamic. You've had a huge amount of savings increase on both sides of the Atlantic. That money's been parked in money market funds. Then at the same time, the commercial paper supply in Europe has dried up to some degree as well. And Jeff, I'm looking at that dynamic and I understand it. Demand, lots of it. Supply, not so much at the front end. OK, this is where yields go. I'm trying to understand whether that dislocation, if we can call it that distortion, persists over a period of time once people start to re-engage with the economy, Jeff. What are your thoughts on that situation, that dynamic as it evolves?
Yeah, on the commercial paper side, quickly, it's the flip side of what we're seeing in terms of households. Not only do you have, household savings, you also have corporate savings. And so when corporations have been hoarding cash, there's less need for what commercial paper is. It's a source of cash. It's the corporate credit card, if you will. And so there's just less available demand for liquidity from corporations because they themselves are awash in cash. And so that's limiting investors' opportunities in that part of the market. To the second part of your question around, kind of what happens when the real economy re-engages. I mean, this is really a financial market consequence here. You have the real economy drivers, COVID, the shutdowns, the loss of liquidity, and then the massive Fed interventions. And that's fueling the financial market liquidity from which all of these other aspects are occurring alongside the kind of holding down on interest rates as part of the explicit policy. So the real economy re-engaging is going to add to that dynamic. It's going to add a fundamental element to that dynamic as you start to perhaps increase real economy velocity on top of the broad and base money acceleration. That remains to be seen, but we're certainly talking about the re-engagement of consumption, real economic activity, but the impact in financial markets of this excessive amount or historic amount, if not excessive, liquidity has really been with us here for some time.
The velocity of money takes us to the inflation conversation, Jeff. The back end of the yield curve backing up again, up by 3 basis points. It seems that 1.2% seems to be the ceiling at the moment that we're struggling to break through on a 30-year in and around 2%. Jeff, can you give me your guide on how you expect the longer end of the curve to evolve as the year progresses, given this conversation we're all having now about inflation pressures?
It's a continuation. We've been in a bear steepening mode here for a while, and it's reflective of all the dynamics that are going on between monetary policy, fiscal policy, re-engagement, and critically, the willingness and the hope for an increase in inflation expectations. So the Fed's shift to flexible average inflation targeting, the speech we got earlier this week from Jerome Powell, all are highlighting and reinforcing, expectations from market participants that the Fed wants to see higher inflation. And as long as it's not a disruptive increase in market reflection of those concerns, certainly fundamental measures, real measures of inflation take a long time to kind of develop, but markets can overreact. As long as there's not an overreaction and it's this kind of gradual steepening of the curve, gradual increase in inflation expectations, I don't think the Fed feels any need to intervene. If anything, they're welcoming that change. That's exactly what they're saying they're looking for. The policy is set for overshooting, so it's giving the market a lot of room to reprice the term premium, inflation risk premium out the back end of the curve.
This is arguably what they want to see in the bond market. The front end pinned, the long end starting to bleed higher off the back of higher inflation expectations. Jeff, I guess the question is, for market participants, if higher yields at the longer end are driven by higher inflation expectations, is that a threat at all to broader financial conditions?
Not if they're gradual and can be absorbed in terms of issuance spreads, availability of capital. The real economy impact is not disrupting. Man, look at the flow of new issue activity across the spectrum, whether it's high yield or private or what you're seeing in the equity markets. There's no disruption here in financial markets from a gradual increase. And we have to take a step back and recognize that even though we're coming off of very low interest rates and we're seeing some significant changes to those term premiums, there's still exceptionally low financing rates and exceptionally compressed term premiums. So unless it's a very aggressive move and disruptive, I don't think this disrupts the financial conditions and certainly any change in terms of macro monetary policy.
This does, of course, raise a question about portfolio construction, which is something that dominated your outlook coming into 2021, Jeff. I just wonder how you think that the bond market, treasuries, correlates with risk overall, given the setup that we're looking at right now.
Yeah, it's a really challenging environment for portfolio construction. Not only are you facing this conversation of the prospect for rising interest rates and steeper curves and the headwinds that delivers a fixed income portfolio, but you're starting at very low interest rates. And there are two consequences to the starting point. One, just expected returns from the yield from the income component are very low. And two, because you have very low long-term interest rates, even though we're talking about some increase in those rates, the degree to which long-term interest rates are starting so much lower than we've had at any other period, the ability of fixed income to deliver the other side, not returns in good markets from income, but returns in bad markets, in difficult markets for equities from falling interest rates, is just that much lower. And so the combination of these three elements, low starting yields leading to low expected returns, the prospect for higher inflation, steeper curves, headwinds of negative price appreciation from rising interest rates, and then the inability or not inability, but the lower ability of fixed income to provide diversification. It's all really forcing us to rethink. You've heard it a lot. We'll say it again, rethinking 60-40, rethinking the role of fixed income. It's just not the asset that it was. So you need to diversify away from that into other solutions that can provide the roles that fixed income used to.
That's where I wanted to finish, just on a final question, Jeff. On the 60-40, a lot of people spend a lot of time talking about the 40 side. What does the bond mix look like? You spent a bit of time thinking about what the 60 would look like relative to what the bond bit should look like. And I just wondered, Jeff, can you just, in a short amount of time, explain to our audience how you're thinking or rethinking the 60 side, not just the 40?
Yeah, exactly. It's a very kind of important observation. If you've lost some of the diversification ability, which we're arguing here, the low levels of interest rates, the proximity to zero means the 10-year interest rate can't fall the historical 300 basis points that it once did, then you have more risk in your portfolio because you have less diversification from fixed income. So you got to think also about what does that mean about the 60. And so you can take on more defensive equity strategies in that environment as well. So thinking about how you retool the higher risk portion of the portfolio, as well as thinking about retooling the safer 40% of the portfolio.
Jeff, really smart. Always really smart. Always great to catch up, sir. Enjoy the long weekend.
Thanks.
We'll catch up soon. Jeff
You too.
Rosenberg there of BlackRock. Time now for the final spread, the week ahead. Coming up next week, US markets closed on Monday for President's Day. The Fed minutes and US retail sales coming up on Wednesday, initial jobless claims, and Fed Governor Lael Brainerd speaking on Thursday. And finally, closing out the week with US and Eurozone PPI on Friday. Look out for prices at the factory gate, given what's going on all around the world right now. From New York City, that does it for us. We'll see you next Friday at 1 p.m. New York time. That's 6 p.m. in London. This was Bloomberg Real Yield. This is Bloomberg.